Joined us. Good morning, Manishi. Thank you for joining us. Manishi,
Hi there.
a question which, in a sense, I'm asking everyone is that what could be the second derivative and the third derivative impact on oil, on flows, on oil companies, on banks, and the entire oil supply chain?
Well, that's quite a few questions in the garb of one. But if we break it down, first of all, if I look at the flows that typically come into emerging markets and into Asia, a significant part of that comes from the sovereign wealth funds. These sovereign wealth funds are in the Middle East. Some of them are in continental Europe. It's no coincidence that some of the larger sovereign wealth funds are, basically in oil-dependent economies. So, and this is something that we had seen during the global financial crisis also, that a collapse in oil prices always leads to drying up of these flows. Second, one must also remember that it's not only a decline in oil prices that we are seeing. In fact, the oil price collapse has possibly been the most spectacular, but in general, it's been a commodity collapse. It's not just recently, but over past 1 year or so. And that really indicates a global demand softening. And the implication of that is obviously a degree of risk off sentiment, which leads to flows gravitating towards the safe haven assets like bullion, like gold, like US treasuries, and so on and so forth. So it's a combination of many things that are right now leading to flows gravitating out of emerging markets. India is not going to be and has not been an exception to that rule. Second, the point that you made about the implication on banks, we think that as a consequence of the commodity boom that happened right after the global financial crisis, there are many banks in this region who had a significant degree of exposure to the commodity manufacturers. Now, I must point out that over the last 2 to 3 years, this exposure has actually declined somewhat. We knew of Singaporean banks which were significantly exposed to oil companies, to oil refiners, and even to oil exploration platform manufacturers. Their exposures have declined. There are a few Indian banks, both in the private and public sector that we know about, who have such exposures. But at the same time, I would think that that's today, at least, it's possibly not a systemic risk that that the sector suffers from.
Manishi, so when will this differentiation factor start kicking in? A, India, touch wood, we've had less casualty because of the virus. On the medical front, fantastic news. Second, on the oil front, this is a blessing in disguise that oil prices have come down. No other economy in the world, excepting China, can claim the following: that we will benefit on a macro front because of crisis, and our medical situation is better than what others currently have. So when there are two, when the big picture argument for India is safe and on a relative basis is better than others, why are FIs selling?
Yeah, one of the reasons is that ultimately for this entire region, um, the manufacturing universe, even the services universe, as far as India is concerned, is dependent on global demand, and particularly the demand that arises in the Western Hemisphere, in the developed markets. So, as long as we continue to see demand destruction in the developed markets as a consequence of COVID-19 proliferation, things are not going to really return to normal in a hurry. So what we really have to watch out for is a control of the outbreak in the developed markets, particularly from Indian context in the United States. And I think that's the factor that really would give some comfort to the investors globally, which could potentially sort of trigger back some degree of risk on sentiment and therefore some degree of flight back into emerging markets. So until and unless that happens, the control of the virus, a visible control of the virus in the developed markets, it would be premature to expect a return to normalcy.
Do you worry about the kind of selling private banks in India attracting? The logic here is that, look, there is going to be in retail delinquency. Up until now, private banks have managed to manage their books well because the Indian retail was growing, and retail borrowers had very little credit delinquency. But now that job losses will be obvious, companies will be doing cost cutting. Do you think one should now worry more about retail franchises also?
To some extent, yes, but I think the potential delinquencies in the retail lending sphere would possibly impact the non-banking finance companies more than the organized large frontline private banks. The private banks are gaining market share and they would continue to gain market share in the foreseeable future over the public sector banks. That's point number one in their favor. Second, I think on an average, if one looks at the top few private sector banks, the retail lending private sector banks, I think their asset quality is significantly better than the larger NBFCs. After all, I think their proportion of collateralized retail assets is a lot more. On the other hand, the NBFCs possibly have more of non-collateralized assets. So, in the banking and financial sector, we continue to focus on the private sector banks, predominantly the retail lending private sector banks. We are avoiding NBFCs for the time being. And of course, insurance remains another one of our favorites. I think their asset quality is significantly better than the larger NBFCs.
Right. Manishi wanted to understand, how important is it to diversify your portfolio at this juncture? Because just about whoever we're speaking with is talking about as to how safe havens like gold, US dollar, or even US bonds, for instance, may actually be things that you may want to look at. Do you think right now is the time to really diversify your portfolio in that sense?
Well, there are certain asset classes which obviously come up right at the top of investor attention in during times of high risk as we are going through now. So gold is obviously one such example, because in an environment where every central bank in the world is cutting rates and injecting more liquidity, currencies are likely to be volatile, and particularly the emerging market currencies would possibly, depreciate some more. And under these circumstances, it's really those low risk asset that captures investors' focus. So that's nothing to be surprised about. However, I would also point out that even risk assets like equity, they're trading at significantly lower valuations than they used to trade at about 3 months ago, even after this some form of recovery, some measure of recovery that we have seen over past 3 weeks. And within equities, there are certain sectors which are possibly less impacted, or somewhat paradoxically, even positively impacted by what we are seeing. Healthcare is one example. In the context of some of the Asian markets, like in China, e-commerce or social media, some of the internet or mobile handset game developers, they would fall into that silo. In the context of India, the consumer staples, particularly those consumer staples companies which are focused on sanitation, hygiene, and other day-to-day use lifestyle products, they would obviously be in that silo. And many of these consumer staples companies in India also would have significantly lower input costs as a consequence of the oil price collapse that we're seeing. So, while the risk asset universe may look like a no-go on the surface, there are certain micro categories which could, which would still be investable. And, in these large markets like China and India, there are quite a few of them which present themselves to the investor universe.
Not sure if you've already discussed it, but pharmaceuticals as well, and the kind of renewed interest, Manishi, that the world is now seeing in Indian pharma. The fact that from the March lows we've risen about 48% for the index alone, the most under-owned, beaten down since 2015. I mean, this is not just a few months or 1 year that I'm talking about. And suddenly you're seeing, just about everyone chase the pharmaceutical names. It's at an all-time low. It's the second largest exporter right now, and the certainty of earnings post the FDA clearances is now, really increasing. Would you relook at pharmaceuticals, and would you want to buy afresh if you already own some pharma, because the prospects are now getting even better by the day?
Healthcare sector in general, both pharmaceuticals, maybe even some of the hospitals, has been a significant outperformer in the Asian context. So we have seen such outperformance from the Chinese healthcare companies. We have seen such outperformance from the Indian healthcare companies, and even some in the Southeast Asian region. This is not surprising when this whole economic lockdown or the economic slowdown is actually triggered by a healthcare crisis. So it's natural that the healthcare sector would be in focus. That said, we would also point out that in the Indian context, in the pharmaceuticals universe, investors need to be cautious because, or to put it more appropriately, they need to be selective, because there are certain drugs or certain categories of drugs which have been in focus. And one would obviously have to select those companies which are in the manufacture of those drugs, and the companies which are able to weather the storm of the troubles that they have been having with the US FDA historically, or in other words, the companies that have been able to negotiate the US FDA related problems would obviously be in the winner's seat. So those are the two factors that investors would have to take notice of.
Manishi, there are a lot of reports coming in, particularly, more focused on the global markets, that suggests that the real recovery may take as long as 3 to 4 years, particularly in some of the sectors worst impacted. Do you feel that's going to be, a similar situation that we see here, or that India will do relatively better, recover a little faster, perhaps? And given also perhaps a lesser dependency on the overall, global dynamic that continues to play out between US and China?
The Indian economy has both pros and cons under the current circumstances. Number one, as I think Nikunj earlier pointed out, the relative number of fatalities in India has been low. But at the same time, the stringency of the lockdown that's been implemented in India is actually significantly higher than what we have seen in some of the other countries. I'm based in Hong Kong, and over the past few months, I have actually been in office. Even though we've been operating on split locations and very sparsely populated offices. So the stringency of the lockdowns have been different in different countries. And in case of India, since we have a very large proportion of informal sector workers, the inability to find jobs, after the lockdown is lifted, could be actually a significant drag on consumer demand on incomes. So this is something India would have to watch out for. And while there has been an economic welfare package, we haven't really seen a broad economic recovery or a support package like several other countries have implemented or announced. On the other hand, as we are seeing today, the fatality rate is a lot lower in India. So which obviously ignites hopes that after the May 3rd deadline of when the lockdown is lifted, the economy would be gradually chugging back into some degree of normalcy. And finally, I would point out that this whole commodity collapse, particularly the oil price collapse, actually helps India in a big way, not just in terms of the current account deficit shrinking and therefore supporting the currency, but also in terms of manufacturing companies' margins being supported. We had done a study earlier where actually we had shown that manufacturing margins all across Asia, but particularly in India, they tend to have a strong negative correlation with commodity prices with a 2 to 3 quarter time lag. So commodity prices go down today, margins tend to improve possibly 2 or 3 quarters higher later rather. So it is basically the second half of
Right.